spotlight on Ceat as the company has announced that their acquisition of CAMSO business, that is finally done, and from September onwards, they will have the integration kicking in and the synergy benefits as well. So let's try to understand that what could be the financial impact of that on the company's financials, and along with that, what are the other set of triggers for the company. We have been joined by Arnab Banerjee, MD and CEO of Ceat on the show. Very good morning, Mr. Banerjee, and firstly, congratulations on closing the CAMSO acquisition. But firstly, if you can help us understand, what will be the financial impact of this? What's the initial quarterly revenue and EBITDA run rate, and what are the one-time integration transition costs, if there are any?
As we take over the business effective September, the annualized revenue impact would be 10 to 12%. The plant that we are taking over along with the business is utilized up to 50%. So there is significant headroom from this plant itself without any great capex further. So that's the top line part. On the bottom line, on the margin front, on EBITDA basis, once things stabilize, which will take at least 4 to 6 quarters for us to get a handle on the complete supply chain and understand the business, we expect this business to be generating EBITDA in high teens, close to 20%. So it will be EBITDA accretive after a period of 4 to 6 quarters, where we will see a gradual increase in profitability.
Right, and any mix of tailwinds from off-highway tires or tracks in EU and North America, aftermarket or original equipment side?
North America, you know, is under tariff situation, which is 50% for India produce and 20% for Sri Lanka produce. So Sri Lanka is not competitively disadvantaged vis-a-vis other countries which could produce compact construction tires and tracks. Hence, we expect to explore and grow the market of US from Sri Lanka produce, business as usual out of there. India tariff situation of 50% is not conducive to growth in US, so there will be a pause till we have clarity on further improvement in the tariff situation out of India. EU is doing as business as usual again, slow growth rate, but we have low market share in EU, Ceat. And CAMSO has a significant presence in EU, so there will be a lot of synergies in terms of accessing the same set of customers by way of distributors in aftermarket and OEMs in EU. So we expect to ramp up volumes for both CAMSO and Ceat agriculture tires in EU as soon as possible.
Sure, Mr. Banerjee, now that we're talking about tariffs and CAMSO, can you tell us what the current exposure is of CAMSO and the domestic business to United States compared to what it was before the tariff implementation?
For the India business, excluding CAMSO, our exposure is very low to the US, less than 3%. Out of that, 1.5% is about is the contribution from the OHT business out of India. So that is witnessing 50% tariff now. The balance 1.5% of our exposure to US is witnessing 25% tariff, which is passenger car tires and truck bus radial tires. So as far as passenger car tires and truck bus radial tires are concerned, it's a category level tariff, which happens to be 25% across the world. So there is no competitive disadvantage there. We will continue to explore and grow the US market for these categories. As far as OHT is concerned, 50% tariff is uncompetitive. So to the extent of 1.5% of our business, we will see a pause. However, the Sri Lanka, as I mentioned, is under 20% tariff, which is competitive. So we'll continue to grow the OHT business out of Sri Lanka to US.
Along with that, Mr. Banerjee, help us understand your pricing strategy with respect to tariffs. Will that be a pass-through? Is that something that you are planning right now? And what will be the demand elasticity that you are building on into the second half of this fiscal?
For Non-OHT categories, we are not in an uncompetitive situation. So we will see how the market is reacting to the pass-through of the 25% tariff. It will go up in stages with us absorbing some part of it and then gradually adjusting the margins to the extent the customers are willing to pay for. For 50% tariff is not workable. Similarly, for 20% tariff ex Sri Lanka, we will follow a similar approach, some absorption to start with and gradual easing out with increasing prices to the extent the customers are willing to pay for.
Right. Mr. Banerjee, your debt stepped up for CAMSO as well. Tell me what's the peak net debt and net debt to EBITDA that you're comfortable with for FY26?
See, our overall capex would continue in the bite size of 1,100 crore kind of thing, which we have been mentioning. The debt level will see an accretion because the CAMSO acquisition will be funded 70% by debt, 30% by way of equity or internal accruals. So we will see the debt level go up in FY26, but given the strength of our balance sheet, the ratios, if I may mention, debt equity could be moving from 0.4 levels to 0.6, 0.65 levels. Debt EBITDA, which is even more critical, could move from about 1.2 odd levels to somewhere near close to 2. So much below our guideline of 3, which is the debt EBITDA level. So we are confident enough to be able to handle this level of debt through our business growth and internal accruals.
All right. And Mr. Banerjee, what is your expectation on GST rate for tyres? And suppose if tyre GST, which is currently at 28% on most categories, is rationalized towards that 18% slab, what replacement demand uplift do you model in different categories?
We don't know for sure, but we are expecting a lowering of GST rate from 28% overall to about 18%. It could be lower in the case of farm tyres to even 5%, but we don't know the exact outcome yet. If this were to happen, I'm sure it will give a fillip to tyre demand in the replacement market, in two-wheelers to a great extent, on farm tyres to a great extent, and even on truck, bus, radial and passenger car tyres. So it's a very, very positive move by the government. I'm looking at it quite positively.
Mr. Banerjee, you have earlier guided for a double-digit revenue growth in FY26 with higher OEM momentum. So does the CAMSO lift that trajectory, and what's the updated growth EBITDA band for the year?
No, we'll stay with that guidance of double-digit growth excluding CAMSO, because CAMSO is a new entity and we'll handle that for only 7 months during the financial year. Also, you mentioned about GST. There'll be some headwind in the near future because channel partners may adjust their stock levels because the rates will go down significantly as expected. So that's a headwind. But overall, in the long term, we are quite bullish. But again, 6-7 months is too short a period to make any big significant changes to our projections. So we'll stay with that guidance of overall double-digit growth for the India business in this financial year.
Right, Mr. Banerjee, thank you so much for your time today, and